and welcome to Fidelity Connects. I'm Pamela Ritchie. Markets have been anything but predictable over the last 4 years, and for some investors, it hasn't exactly been their type of market. Our next guest says it's time to look beyond the Magnificent Seven, explore overlooked spaces. Joining us here today to share his perspective on today's markets, including where he's finding value-oriented investing opportunities around the globe, is Portfolio Manager Dan Dupont. Hi, Dan. Great to see you. How are you?
Good morning. Good to see you too. I'm not telling anybody to do anything. I'm just saying it's what I'm doing. I'm looking outside the U.S.
We're just going to ask you what you're doing and how that's working. Go over sort of the hangover effect, actually, of what the rate story has done a little bit. We'll just sort of back up for a bit of history. We all got used to very low interest rates for a long, long time, and that sort of had the growth stocks taking center stage, maybe for a longer time than they normally do. Come back to value investing for us. Are we coming back to value investing at this point? It's a different rate story.
Yeah, I think it's taking a while, but I do think the fixed income markets in some areas adjusted faster than the equity markets. You know, we stare at the screen and we look at the results from every company every day, but you know, if you take a step back, you know, rates were very, very low. They were practically zero in the U.S. Government level for many, many years. In fact, around the world, we went from having no bonds that were yielding negative yields up to $18 trillion in 2021. And when the Fed started raising rates, it only took about a year for that number to go back from 18 trillion to zero. And so the fixed income markets are a bit more aligned with what they should be. But in general, you know, corporate spreads are still very, very tight. And so everybody's now adjusted to the idea that maybe there won't be another recession for a while, even after 15 years of, you know, no real volatility in economic output other than, you know, obviously COVID. But in terms of credit spreads, they really didn't expand for more than a week and a half. And then at the stock market level, growth has outperformed value pretty much almost every year for the last 8-10 years, which historically is kind of an anomaly. And so we've gotten ourselves to a place where obviously, if you look back, you know, growth has outperformed value massively, large cap has outperformed small cap massively, and the US has outperformed the rest massively. So there's a lot of concentration in very large cap growthy US names. And it's to the point where, in my view, it's now actually very, very attractive to look outside the US. There's some very, very cheap names. In fact, in Canadian Large Cap Fund, if you take everything I do that's more defensive, about a year ago, we were probably closer to 25-30% in liquidity. And currently I'm around 10%. Obviously, that hasn't been deployed in the US or large caps or you know, any of the Mag 7s, for example, but it's been really outside the US, Europe, Asia, small caps, mid caps, large caps, even some emerging markets a little bit. But I'd say, you know, maybe the run that we've seen is going to continue, but we are certainly at historical extremes. And frankly, the math is starting to be hard to align with long-term performance that is decent for a lot of these US-centric growthy names.
So it sounds like your positioning right now and maybe your view of the world at this point is a little bit of a ground zero for the everything else trade. Is that right?
Yeah. So if you look outside of the you know, big cap US names with either growth or perceived growth, there are a decent number of opportunities. So yes, if you look at my funds, generally they're much more weighted to outside the US, where the opportunities are, and they're in somewhat defensive areas too. You know, staples and a bit of healthcare is attractive, and you know, emerging markets, which I've never really been interested in or invested in. It's starting to be a place where I have a decent number of positions across the board.
So interesting. Okay, so go to the relative opportunity here. It's a value trade, but it's a relative opportunity. You mentioned the history of how long we've been sticking with companies that have been more growth oriented, and that maybe has left stock prices depressed for other companies, so-called value companies. Why haven't they been taken out, for instance? They're still around. They're still there for you to buy. at a lower rate. At this point, they would have lower stock prices, and bigger company surely would have come along by now, or no?
So that's a good question, and I think first of all, if you're in Europe, typically there's going to be less M&A. It's just a less M&A driven market. The U.S. is more of an aggressive M&A market, and private equity is very, very U.S. centric. There's a lot of money involved in private equity, and it's much more established in the U.S. They're probably 10 times or 20 times bigger than Europe in terms of how much cash they can deploy quickly. So that's been part of the reason why they're less interested in Europe. But I think over time we've seen, like in the UK, we've seen an acceleration of takeouts in the last year or 2 years. And I think it's a trend that's going to continue because some of these stocks are just too cheap. Now, there's also the idea that Europe resembles a little bit more Canada in some ways. There's more family controlled companies in the small mid cap area, but in general, we're seeing a bit more M&A in Europe and in Asia.
Okay, really interesting. In terms of emerging markets, give us a sense. Actually, I think we spoke to you in the fall, not long after China, a little bit out of nowhere, released some stimulus, and we just saw markets rocket. I mean, off very low levels. But you were involved in China at that point. Are you still?
So I was. I basically came out of China in a big way. I was still somewhat interested. I had a few small positions here and there, but that ramp was so aggressive, and these valuations became less interesting to me. Emerging markets have to be really cheap for me to get really interested. I need that margin of safety, like a deep margin of safety. But it came back to us, and so China's been again a position that we've had in even Canadian large cap fund, which is allowed up to 49% foreign content. So we've used some of that content to put another bigger part of the foot, and not only a toe, but a bigger part of the foot in China, and that's been beneficial year to date. But again, I try to do it relatively smartly, not go too aggressively, and have a really big margin of safety, independent of the position.
I think you also told us when we spoke to you sometime in the fall that there was a little bit of "I told you so," because you were talking about Europe then. When I think we were gearing up for the U.S. election. It was not really front and center that discussion, and then and I mean Europe's been up by about 10%, give or take, this year.
So year to date, Europe's done really well. Obviously, after the election, that was the opportunity. The U.S. dollar was really strong. The U.S. stock market was really strong, and the rest of the world was just forgotten. And so it was really, the most aggressive investment into the U.S. market by foreign investors. Capital was trying to find its way into the U.S. So a lot of exuberance and excitement about U.S. after the election. So we had about a 2-month period there where I found that there were a lot of really great opportunities, and I aggressively went after them. So that's when my European position increased significantly. And now, again, year to date, that's been quite beneficial as you said, Europe has outperformed U.S. quite significantly at this point. And frankly, if past this prologue, this should continue for many, many years, although obviously there's going to be some really big volatility around it. US could come back in a big way for a few months or quarters, but generally for me, as a more of a valuation-centric investor, the rest of the world is still very, very attractive. I mean, if you look at cyclically adjusted PEs, I mean, Europe is around 15, US around, high 30s. So obviously, you have to figure out which ones to own because some are higher quality than others. The U.S. on average has higher quality companies, but that is more than priced into most of the securities in the U.S. market. So in my view, that's why one should look outside, and we've seen some of that benefit year to date.
Tell us a little about. So you spoke about staples, actually. Other areas, I think, actually spirits. There's much discussion that no one's going to drink anymore because they're just not going to. Yeah. Yeah.
So spirits is one of the big themes in my funds right now. I never thought I'd own so many spirits companies in such size because they're such great companies historically. They always trade at really, really high multiples because these are companies that have been around for decades, and it's really difficult to disrupt cognac with AI. It's just it's a place where you go back to your specific drink. So brand is important. And
You
these
could drink
companies
your
have been,
connyak while you're doing AI. I mean, you could just have it. Yeah.
that might improve your programming skills for a little bit. Yeah, it's true. While listening to music. So yeah, the story around spirits is severalfold. So first of all, we had the COVID overhang. So everybody started drinking more in 2000, 2001. Everybody was stuck inside. So you put your money in two places. You renovated your kitchen and you drank more. And now that's really kind of rolled over as people have gone back to work, back to the office. They don't drink as much. We've seen the numbers. It's actually quite dramatic. And so the inventories in the channel are really high and they're really impactful. So we have to digest that. That's number one. And then when you have a negative story, people kind of amplify the negatives. And so one of the big negatives people are talking about around spirits is that young people don't drink as much as older people. But, as companies report quarter after quarter, it seems to be a little bit the case, but it's not dramatic. I mean, Heineken had great numbers. Ambev reported this morning, a big Brazilian beer company, really good numbers. So, in general, it's true, but it's not completely dramatic. And so that's part two. And then the other big one is, the Ozempic story, where if you're on a drug to lose weight, you typically have a little bit less, addiction to either like cigarettes or spirits or alcohol in general. And so that made a lot of people very nervous for good reason, because the alcohol consumption is very concentrated. In the U.S., 90% of the alcohol is consumed by the top 10% of consumers. So, 72 drinks a week on average is that, first decile. These people drink a lot of alcohol. So if you put, a small percentage of these heavy drinkers on a weight loss drug and they stop drinking altogether, that could have a really big impact on alcohol volumes. But quarter after quarter, it doesn't seem to be that dramatic in terms of an impact. But the impact on stock price has been absolutely very, very impactful. So these stocks are very, very cheap. So I never thought I'd have such big positions in spirits, but I'm very excited about these positions. They're very defensive. So if we have a surprise recession in the next year, are these cognac and whiskey companies and tequila going to go down much? I don't think so, because they're already at historically the by far the cheapest level they've ever been.
So interesting. Okay, let's pivot a little bit to some of the Canadian stories that you do or don't like within the either defensive, cheap sectors. I think you've spoken about telecom in the past. There's actually telecom questions coming. What do you think about Canadian telecom right now? So why don't we go there first?
There's a few areas of cheapness in Canada. I'd say don't go too aggressively buying, one company and not sleep at night. But when you have a fund like mine that you can diversify around, I think telecoms are very, very interesting if you can stomach the volatility. The balance sheets are not fantastic, and there's been a fourth player added to the market in the last few years in Quebecor. And so, these two factors together are kind of unnerving people. And then, BC is obviously top of mind for everyone as their stock's been under a lot of pressure. Then Rogers kind of caught up a little bit year to date. Can these companies actually cover their dividend? So these are all questions that we ask of these companies, and we meet with them very, very regularly, and we analyze these things. And I just try to decide what kind of price is right for all of these risks taken together. The satellites are coming into play again, and people think that within 10 years, everyone's going to be able to have, their cell phone work through a satellite, which, the satellite coverage in 2035 in the US is at maximum going to be 8%, according to, I believe, Goldman Sachs. So it's really kind of to help patches where you have difficulty getting a signal. So it could actually be very beneficial to the telecom company. So on average, I'm much more bullish than the average person. Obviously, there's going to be huge volatility because these balance sheets are levered, because there's four players, because the dividend is not covered in some instances in the recent past. But if you look at my holdings, I'm quite comfortable with these risks. But I mean, obviously, this can change, obviously, day to day as we analyze and we meet with the companies and figure out what they're all about. But at least for now, these very uncomfortable areas historically have been a place where I've made decent money.
Okay, really interesting. What about some of the financials? The banks are reporting right now. What do you think of them? They've had their own stories, quite idiosyncratic stories, actually, in some cases. What do you think about the sector? Maybe some more particulars.
Canadian banks in particular are very different from, U.S. banks or European banks. European banks, they fix themselves a little bit, but not much. And they're also still stuck in a lot of their problems from 2012, 13, but getting somewhat a little bit better. U.S. banks have fixed themselves a lot. The problem in the U.S. is that all the risks has been kind of pushed outside of the regulatory purview. So in my view, a lot of the big risks right now are actually outside of the banking system. They're in the private equity world. They're in these, insurance companies inside of private equity firms that are much less regulated. In Canada, we really haven't pushed the banks to adjust anything. We kind of patched everything. And now real estate prices, which is basically what backs pretty much everything in the Canadian credit markets across the board, are really quite expensive. They're 9 times household income for residential real estate. That is pretty much the highest level in the world. And historically, when we had these types of interest rates, early 2000s, for example, house prices were, 4.5 times household income. So, arguably, if house prices in Canada dropped by 40, 50% on average, they still wouldn't be that cheap from a historical perspective. What's obviously helped is that they just kept going up and up and up every year. So the people who own it can actually use the collateral to buy more. And so that's kind of a wheel that turns and can perpetuate itself. But the problem arises when these prices kind of flatten and start going down, which we're seeing now. House prices have been flat for 2+ years. And we'll see where we go next. But for me, for my process, trying to protect people's capital, trying to not lose too much money, I covered the banks as an analyst, and there is really people generally overlook the fact that they're levered around 20 to 1, so $20 of assets per dollar of equity. Doesn't take a lot of mistakes to really ruin your earnings prospects for a year or two, or even make a dent in your book value. So quite a few of those Canadian banks in the past have gone close to the brink, in my personal opinion. I was the analyst, and some of these mistakes were huge, and the Canadian government kind of came in and bought tens of billions and hundreds of billions of mortgages to increase their capital ratios and suspended accounting rules for a while. So everything in the end was okay. But so we'll see what the future holds. Right now, things are really good. Corporate spreads are really, really tight. So there's really not that many clouds on the horizon, but a few of them are really expensive relative to history. Royal Bank's over 2 times book, National Bank's 2 times book. So maybe it's warranted, but for a valuation-centric investor like me, that's a little expensive. And the other end of the spectrum, like you said, there's TD and Scotia that are a bit in the penalty box because of some idiosyncratic issues. That's kind of more where I swim in terms of trying to analyze. Okay, is cheap too cheap? And so the only bank I have right now in the fund is, as last reporting date, is TD. And obviously their U.S. issues have been quite big, lots of penalties being paid to regulators, and now it's been announced that they can start buying back shares again. So we'll see where they go from here. But it's a complicated area. I'm much less interested than the average investor. So 2% is what I own in Canadian banks in terms of Canadian large cap fund.
Tell us a little bit about the commodity side, maybe also sort of the pipeline story. This is going into the tariff conversation a little bit too, and the overall geopolitical situation. Actually, I'll ask you about that, but are you exposed to tariffs? Is there a particular way you've measured that?
So I'm not incredibly exposed to companies that produce things that are exported, except for the pipelines, really. That's one of my biggest areas. But the U.S. needs energy. Obviously, they want to put in the tariffs, but they dropped them from 25 to 10 on energy, and we'll see how that evolves. Our analysts have been just working, over time on what could or might not happen, how impactful it would be. Obviously, if it was a full 25 on most of what we export to the U.S., it would be quite dramatic for Canada. It would be very negative. It would be really tough on. It would be really tough on the currency, and on basically stock market, even if even if they decide to drop the tariffs on energy, even lower than 10. So we'll see how things evolve. We have to look at it every day. But for me, it's mostly the pipelines. The rest, kind of not super impacted by tariffs.
So at this point, I think you mentioned to what extent you were in cash, which is not very much right now. You're mostly deployed. Can you give us a sense of actually the positioning around the globe? So outside of Canada, within Canada, and then maybe we'll talk about your short portfolio a little bit as well. But at the moment, long interest, where are you geographically?
Yeah, so very simply, as I look at my portfolio, 51% in Canada, which is kind of the minimum I have to be, and then I, take advantage of the rest of the world because there's, Canada's 2-3% of global stock market. So if you're trying to look for companies that have really great businesses, not too volatile, not too cyclical, good management, it's much easier to find, 10 or 20 of them outside of Canada. So 51% Canada, about 27% in Europe, about 3% in Asia. There's a few percent in China, a few percent in Brazil. And then the rest, there's a bit of cash and then there's a bit of arbitrage, which is really kind of cash plus, if you will. It's a little bit more risky than cash, but it's a lot of work, but it's really close to cash. So that's about cash and cash equivalents and arbitrage together is a little over 10%. And then most of the investments outside of Canada are in Europe right now.
Okay. So let's take a beat and talk a little bit about the long short alt that you run. Within that, I mean, it sounds like probably you've given us some of your most stories, or I'm sorry, ideas with most conviction. But on the short side of things, does it sort of sum up to taking a look at the very high valuations of U.S. stocks? Is that how that works?
Yeah, so as I look at what is the most extremely overpriced, it does seem to me at least like we're currently in an era where it looks like 2021 in a lot of ways. Obviously, the segments are different, sectors are different. So electric vehicle have been decimated. That's kind of gone, and we made a lot of money on the short side there in 21, and that's gone. Software names were 20, 30, 40 times sales. A lot of that is overvaluation is gone. Cannabis, came and went. For us to short, but I'd say there's just as much exaggeration, if not more, in terms of market cap. It's just a bit more concentrated right now relative to 21 in areas like crypto and AI. Those are the two main areas where there's massive overpricing. And then since the election, I'd say, the in crowd of, the Trump in crowd, anything related to whatever Trump is doing, prison stocks and crypto related, obviously came roaring back. Tesla went through the roof. Or Palantir, which is kind of a government contractor that is really, close directly and indirectly to the Trump administration. So there's been a lot of these shenanigans going on, but I'd say in general, those are the main areas. And now I'm looking also at areas where there's just been so much momentum that people have forgotten how much they want to pay for companies. Obviously, it's not a name that, I need to talk about for my funds, but everybody's talking about Costco, for example. It's a good example of a stock that's, up and to the right, 50 times earnings. Everybody's forgotten what kind of multiple it should be trading at. Everybody that's owned it for more than 5 years will never sell it because they love it too much and there's no price they would want to sell it at. So there's a lot of those in the market right now. I try to diversify the risk because the short book, I don't want it to be too correlated. But I'd say there's been a few really good opportunities to short in the last, 50 years. 2000 was the main one, 2021 was the main one, and I'd say right now is another one.
Okay, there's a question relating to that. We're hearing that Warren Buffett has been moving a lot to cash. Do you see any red flags right now? What do you think of this? I mean, so why right now? Like, why right now is a particularly interesting time to take a look at the shorting parts of the market?
Oh, well, it's pretty obvious that a lot of these companies are not trading on fundamentals, which was kind of a first in 2021. The meme stock era arrived. I mean, we saw it in 2000. It happened, but the market caps were not as big in a lot of areas. And so you look at the cyclically adjusted PE, and I can totally understand why, Warren Buffett's kind of sitting in cash with corporate spreads. Spreads on corporate debt historically have been a good signal as to when to lean more heavily in the market or out of the market. And basically, it's as tight as it's ever been. We're at the lows of, depending on which series you look at, but 2007 or 97. And so there's a lot of complacency. Volatility is really low. I mean, the VIX is not as low as it was a few years ago, but the concentration in the market is such that the VIX should be higher, because there's one big trade that is really pulling most of the S&P 500, and that's the AI trade, which is really kind of dictating what all of the Mag 7 and the top 10 stocks that represent 30% of the index. They're all driven by basically one big trade, one idea. And so there's a decent amount of risk in the market relative to the level of valuation. The balance sheets are really good. That's not a risk. And cyclically, operationally, there is a risk on margins. I mean, margins have never been this high, not even close. So that cyclically adjusted PE is based on margins that have just, kept on going up. And so if you look at margins 15, 20 years ago, they were way, way lower. Yes, the structure has changed a little bit, but we'll see how things evolve post-COVID and if those margins can stay high. But even without that adjustment, nothing in the US market is extremely attractive on the more growthy side. If you look at more of a value side of things, there's a few more things to look at. But again, the US is 3% of Canadian large cap fund right now, and Europe is 27%.
Wow.
That tells you how many good ideas I'm finding in Europe relative to the US, despite the fact that the US is 70% of the MSCI world. It is just the behemoth in the global stock market right now.
If there's a peace deal accord signed, what should European stocks do? Or are you already seeing that being priced in?
I'm not sure we're seeing a lot of that priced in already. I think there's a lot of skepticism around that. So we'll have to wait and see. But I think things just got so extreme that we had some decent performance just off the bottom on a lot of these European names. And so if there's a peace accord, I think there's another big leg up to go. Okay,
more room to go. Dan Dupont, we'll leave it there. Thank you very much for sharing your ideas and thoughts and how you're currently positioned with all of us here today. All the best.
Thanks, man.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.